Good afternoon, everybody, and welcome to the half-year results for Redefine. It's going to take you through the introduction and the strategy. Andrew will take you through the financial, and David will take you through where we are in the portfolio and the property side. You're all quite familiar with who and what Redefine is, and our structure is unchanged from the year end. Total assets under management, 37.3 billion. That includes international, which we'll deal with separately. And our direct property portfolio, just under 20 billion, listed of 4.7 billion. So in terms of our strategy and objectives, this will give you some idea of the progress that we're making. Securing long-term growth and capital appreciation, still in progress, but we're making good progress. Focused property management to grow income and lower operating costs. Again, we're making good progress there. Strategic investments in listed securities to transform Redefine from a hybrid into a pure property play. I think you all know the initiative that we've taken in regard to Fountainhead. If it happens, we will be out of the Hyprop investment. Our management of local debt to lower the cost of funding, very good progress on all fronts there. Real growth in international markets, again, doing and exploit and identify and execute adding development and corporate opportunities. We certainly are making very good progress on that front. In essence, from a Redefine or any property company's point of view, there are four things we can do. Grow income, difficult in these times. Lower expenses, we're making some progress. Lower the cost of debt, we're making good progress. And then add value. The best investments we can make are into our existing properties. That's where we can get double-digit growth, and there's a big focus on that. So, Fountainhead acquisition, some of you have seen this before, and this is the rationale for the acquisition. It is, as we've said previously, subject to regulatory approval by the Financial Services Board and the Competition Commission. Those submissions are in the process of being made, and once we get those, and if we get those, then we'll be in a position to undertake a full due diligence into the underlying assets and formulate an offer which we believe will then be fair to Fountainhead shareholders as well as to Redefine shareholders. And of course, any offer that we make will be subject to the approval of both sets of shareholders. So it's a time process, and we will keep everybody posted of progress as it happens. Just to give you some idea of the improving the quality of the portfolio, this is the PEP Stores warehouse, which we've alluded to previously. It has just been handed over to PEP for beneficial occupation. It's enormous. The combined thing is just over 100,000 square meters, and our return is in double-digit figures. On this one, it's been brought in below budget. PEP have sent us one of the biggest developments that we've been involved in with the least hiccups. That's an email we got from Marius Barkhuizen from Pepkor Properties. It was a pleasure dealing with them, and I believe that they have the similar view from us. This one over here is one that we're now busy with. It's a site which we have an existing building in the south. Scania wanted some additional space or new space, which we had space on the site, and we're in the process of developing and redeveloping that for them. Again, we'll show double digits on the cost. 90 Grayston, we're about to go on site. This is the property right next to Investec. It's a little 4,000 square meter building, very old, and we are planning an 18,000 square meter development, which you can see on the right. It's on spec, but if we achieve the budgeted rentals, it should show about 9.5%. This one's quite impressive. This is the Alexander Forbes building opposite Sandton City. That's our proposal. There's a series of buildings. We're not going to do anything on this one until such time as either 90 Grayston is substantially pre-let, or we have a tenant to kickstart the building, but we will probably demolish the building in the course of this year. Essex Gardens, an office block in Durban. We had an inquiry from one of the major tenants, TBWA, for more space, and we've now completed a new office block, and we'll be upgrading and adding to the existing. This is Maynard Mall in Cape Town, where we've made substantial improvements, and we're now continuing with the second phase internally, and that's working very well. This one, Shoprite Para, quite amazing. This was a building which was deteriorating. We were going to sell it. We had an offer of about 75 or 80 million. We decided to see what we can do. We refurbished it. We put in a Chinatown, which opened about 2 weeks ago. It was just edge-to-edge people, still trading particularly well. Shoprite have exercised their option, and we're in the process of finalising a new lease with them at a higher rental. So again, this is going to be 11.5% to 12.5% return on the new money invested. Park Meadows, it's a property in Eastgate. If you see the comment there, we thank all Redefine staff for their complete participation in bringing this excellent site to fruition. Food Lovers Market opened about 3 or 3.5 weeks ago. We had this building is in 2 sections. The top section where Food Lovers are was very weak, and now we have an anomaly where you can't get parking on that section, and there is parking on the lower. So we're faced with the challenge now of having to provide additional parking on the site in order to cope with the number of people coming to it. That's really where we are in our strategy, other than to say we continue to look for acquisitions that will improve the quality of the portfolio. We continue to look for value-added opportunities. We're very happy with the half-year results and the progress we're making for the full year. And I think that as shareholders, the Arrowhead unbundling has proved successful. There were some skeptics. Glad to say that you were wrong and we were right. So without further ado, I'll ask Andrew to come up and take you through the financials. Andrew.
Okay, just looking at the financial highlights for the first half of financial year 2012. You can see a half-year distribution of 31.5 cents. Our core business, that's the properties that we still hold after the unbundling and the various restructuring initiatives completed, up 6.6%. I'll go into that a bit more in detail in the next slide. Total tangible assets, we have now 40 billion rand under management. Our market cap, just over 22 billion rand. And our fixed borrowings, now at 72%, are fixed for an average period of 5 years. We're very pleased with our domestic medium-term note program. It's coming together nicely. We've established a presence now, whereby we've now issued a 3-year 500 million rand bond, the outcome of which was very pleasing, achieving an all-in rate of about 7%. Our 250 million rand commercial paper issue has been rolled twice since the initial issue, and the last issue came in very favourable, under 6%, and we'll continue to do so in due course. Operating costs as a percentage of rental income have decreased, and once again we'll go into that in a bit more detail in a little while, but essentially the efficiencies from internalisation of property management are now coming through. Just unpacking the half-year distribution, overall we've grown 1.6% on last year, achieving 31.5 cents against last year's first half of 31 cents. However, if we deduct from last year's result 2 cents in respect of Arrowhead, you'll see that our core recurring income is about 28.9 cents, and that gives rise to a 6.6% growth on the organic business on last year. So overall, as you can see, 31.5 cents. However, within that, a very pleasing achievement from our organic or our core business growing just over inflation. Looking then at our distributable income in detail, as you can see, most of our income comes from rental income. That's approximately 82% of our total revenue comes from income from investment properties. Our listed securities, as you can see, have decreased slightly year on year, but that's mainly due to last year recognizing pre-acquisition income on Hyprop, which if you remove that will once again reflect good growth in the current year. Fee income has shown some growth, and then admin expenses, as you can see, up just under 21% on last year. That's essentially due to a bit of catch-up on a phantom share option scheme that we have in place, as well as some additional marketing costs. Distributable income from associates, that's our share of Cromwell, the listed Australian property unit trust company that we've invested in, and that number will grow in months to come. That's just the initial distribution since December. Finance costs, as you can see, a pleasing number in that it's 1.7% down on 2011. There's a number of reasons for that. Just to name a few, we've moved to a 6-month interest distribution cycle, being one. The other would be the benefits of being active in the debt capital market coming through. And then we've also managed to hold our funding levels down as a result of disposing a number of properties for cash, which we've used to reinvest into investment properties. International income, as you can see, is well up on last year, up 34%, and that comes through as a result of underlying growth from our international business following the Witchford reverse acquisition, as well as some appreciation against the rand from the pound in the last couple of weeks. Moving then on to our core business, as you can see, our core property business has grown very well on the revenue line. It's up 7%, and we've managed to contain our core property costs at just under 3.5% to give us property income growth of 8.7%. We're very pleased with that result, and I'll unpack a bit the core property costs, because within that there are some pressure points that we need to just highlight. As you can see, acquired and development properties, those numbers are a function of properties that have come through during the current year, which were partially in for the prior period, and similarly for disposed properties. As you can see, core property margin, it's looking good at 76%. That's despite a number of areas where there have been some cost pushes. And then you'll see the core property costs as a percentage of property revenue similarly decreasing on last year. Just looking then at our margin on the core business, as you can see, every 100 Rand of property revenue converts into property income of about 76 cents. And there are a number of areas where we've done well, but similarly we've had some challenges. If I go back to 2010 to illustrate what I mean by these challenges, you'll see municipal charges and electricity charges net of recoveries in 2010 represented 4.5% of our operating cost base. That has now grown to just over 6.3%. Now that's almost 1% of margin that's been consumed over a 2-year period in that area. Property management, however, as you can see, has declined from 9% in 2010 down to 4.7%. That's as a result of the internalization of property management, which has offset the pressure that's come from municipal and electricity charges. And then bad debts, as in the current period, grown quite substantially on 2011, and going back to 2010 even more so. In 2010 we were at 0.4%, it's doubled now to 0.8%. It's still quite a low number relative to our property revenue, it's under 1%. However, we have had a number of bad debts coming through, mainly as a result of our smaller retail tenants defaulting. As you can see on the property portfolio ratios, we are doing pretty well. Our property management costs looking good at 3.2%, and then municipal charges as a percentage of recoveries and electricity charges as a percentage of recoveries, not where we would like them to be, but certainly these are areas of focus going forward for us. Just unpacking a bit on the property cost push on last year. As you can see, municipal charges have grown about 18%, and electricity charges 13%. Once again, we are to some extent at the mercy of the service providers or the utility service providers, and we can't pass on all of these costs to our tenants. In government's case, we are unable to because of the nature of the leases. And in terms of electricity, there's an argument of cost of occupation which inhibits us from passing on all cost increases to our tenants. Property management, as I said, showing pleasing decreases on last year as a result of the benefits from internalisation. And then you'll see on the other cost line, that's growing quite significantly at 18%. And that comes as a result of bad debts increasing. We've had some wage pushes in the areas of cleaning and also in security. Security is also increased as a result of our guards being upgraded, as we no longer have E-grade levels, they're D and upwards going forward. Looking at our balance sheet, what we've done here is we've split our balance sheet into local and international, just to give you a sense as to how the numbers come together. As you can see, the local balance sheet has total assets of just under 27 billion rand, and we have interest-bearing debt of about 8.3 billion rand. That's a gearing percentage of about 31%. And our international operation has assets of 17 billion rand. Against that, they have got debt of about 11 billion rand. And in percentage terms, the gearing would be 67%. So in total terms, our total assets at just under 44 billion rand has debt against that of 20 billion rand, which translates into gearing of 45%. And you'll note that our net asset value has decreased from 784 cents last year to 752 cents this year. Then the main reason for that would be the unbundling of Arrowhead, which caused a 30 cents decline year on year. Just looking at our listed securities, not much has changed since August. In effect, it's just been value changes as a result of share price movements. Holding-wise, we are virtually the same. It's worth noting that Dipula has been disposed of in the last couple of weeks, and the transaction is subject to funding being approved by a financial institution. Cromwell, as you can see, it's accounted for as an associate. As a collective, the group holds 27% in Cromwell. South Africa, or Redefine Properties Limited, owns just under 4%, and Redefine International owns the balance. Looking at our funding, as you can see, 72% of our funding is fixed locally. That's 5.9 billion rand, 2.4 billion rand floats, and that gives us our 8.4 billion that we've borrowed locally. There's non-recourse international debt of 11.2 billion rand, which brings our total borrowings to just under 20 billion rand. In terms of our loan-to-value target, you'll see we're slightly up on the target of 30% at 32%. We're quite comfortable at that level given the level of interest rates at the moment and the cycle anticipated to remain essentially where it is. Our weighted average cost of borrowings has shown pleasing declines from 9.6% last year to 9.4% this half, and we expect that average to decline further to closer to 9% by year end if all our initiatives come to fruition and we are able to access further funds from the debt capital market. Average length of fixes just under 5 years, and we still have a healthy funding headroom at 270 million rand after adjusting for possible acquisitions, developments and disposal of properties. From a cash flow point of view, as you can see, Redefine generates a healthy cash flow. Locally, 1.2 billion rand was generated this half. International, 200 million. That's 1.4 billion rand in total. And that more than sufficiently covers our interest and our linked unit distributions that we paid during this period. And as you can see, we've been raising sufficient funds to invest into further expansion opportunities. International has restricted cash of about 159 million rand of that 450 group cash on hand at the end of the half year. Looking at our top 10 unit holder profile, as you can see, the top 10 unit holders hold just under 40% of Redefine, and not much has changed there in terms of the pecking order. There has been some movement, but essentially it's the same. As you can see, there is one international investor, Vanguard, owning now 2.4% of Redefine, now in the top 10. In terms of free float, our liquidity is high. As you can see, 80% plus is our free float. And moving on to our international investment component, you'll see that we're now sitting at 13% that's invested offshore into Redefine. That's about 1% higher than it was 6 months ago. And if we do this exact analysis today, you'll see that the international component has now moved to about 15%. So it's growing. And as you can see, most of the international investments are from the USA. From a volumes and closing price point of view, as you can see, there's been a healthy trade in Redefine. From a property counter point of view, Redefine comprises about 21% of the property sector's trades, and that is the highest by quite a good margin in the sector. So Redefine is actively traded, and as you can see, the share price has shown some growth since November last year. Just looking at the total return for the 12 months ended 29 February, if I take the opening price at the 1st of March last year, and I deduct from that the closing price at 29 February, that along with the Arrowhead A and B units, you'll see that the increase in the prices is 85.1 cents. I add to that actual distribution for this half of 31.5 cents, and I add last year's second half distribution of 37 cents. You'll see that in cents terms, we have a total return to unit holder of 153.6 cents, and in percentage terms, that's just under 21%. If one looks at the property sector overall, we are very much in line with the total sector return for the 12 months ended February. Okay, with that, I'm going to hand over to David.
Good afternoon, everybody. This is a snapshot of the portfolio as it stands at the end of the 6 months. Certain of the items I'm going to discuss in more detail later on, but I'll go through. The asset value, as you know, 19 billion. The valuation per square meter and the average property value will both increase as we succeed with our strategy of acquiring higher grade properties. Number of properties, 243. It's down from over 400 at the time of the Apex High merger and from 300 odd last year. Total GLA is just under 3 million square meters, and you can see the split amongst the office, retail and industrial. The vacancy is just under 200,000 square meters and at the moment sits at about 6.6%, and I'll go into that in more detail. The average, the renewal success rate sits at 83%, which in this market is particularly high. The average renewal rental growth at an average of 4%, which we're reasonably happy with. We believe that there's some growth to come from the industrial sector and certainly in certain areas of the office sector. The average gross rental, 68 Rand a square meter. Again, we believe that the office average rental could be higher. It's at that level primarily because of the government holding. The average rental for retail, we believe there's room for growth. We think that given the industrial portfolio, 33 Rand a square meter gross is probably realistic in these times. Average escalations just under 8%. And then the property expense ratio, as has been discussed by Andrew before me. The top 10 properties by value. Golden Walk, you know, very successful centre in Germiston. Discovery, which we acquired last year. Standard Bank Centre in Cape Town, we're due to do a redevelopment, and again I'll discuss later. Sammy Mark Centre, we bought the third portion last year. We've already seen growth in the net income over and above what we anticipated. Tybalt Square, subject to a 3-year head lease from Zemprop. Convention Centre, Cleary Park, Commerce Square, again property we acquired last year. Park Meadows, which Mark discussed earlier in terms of the Food Lovers Market redevelopment, and then Poynton's a property that we've earmarked for sale. Okay, we've said previously that we wanted to try and achieve a ratio of about 30 to 35% of the portfolio in single tenanted buildings. We're at about 30% at the moment, and so pretty much on line with what our strategy has been. The portfolio sectoral spread, well, the exposure is approximately 50% to offices and 50% of that exposure is really to properties within the Johannesburg, Pretoria and Durban CBDs. They're properties that in the midterm we will sell, certainly sell 50% of them, and that will obviously have a very positive impact on our exposure. Out of interest sake, in our strategy we said that we wanted to acquire retail properties of no less than 15,000 square meters. Of the just under 7 billion rand in value of retail, 20 of such properties we hold, and that's about 50% of the total value. The geographical spread, pretty much in line again with what we strategized. We said that we wanted to be invested in KZN, Western Cape and Gauteng. We are invested above 90% in those areas, and that will be pretty much the same going forward. Sector vacancy. And what we've done here is we removed certain properties which in our opinion are unlettable, and it reflects a vacancy level of 6.6%, and the properties are buildings such as 320 West Street in KZN. It's excuse me, it's an old building in West Street, 25,000 square meters of vacant space. It's unlikely that we would ever let it. The cost of letting the space would be prohibitive, and so in order to be realistic, we've shown we've taken that out. Likewise with the Trust Bank building, Poyntons in Pretoria, and a building called Pico, which sits in Bethel. Out of interest sake, if we were to let the 200,000 square meters of vacant space at market-related rentals, there's probably an opportunity to increase the distribution by between 4 and 5 cents. Again, a lot of information on this slide, but let me take you through it. We've started with the vacancy at the end of last year. We removed the unlettable building vacancy and we removed it from the GLA. There are adjustments which will take place on an ongoing basis as one remeasures properties, etc. There are buildings that we've demolished for redevelopment. Then there are the acquisitions and disposals, giving a total of 178,000 of vacancy and about 6%. Then we've shown is the lease activity for the 6 months. So we've shown that there were 464,000 square meters of GLA that came up for renewal. We renewed 384,000 of that, and I've included in that monthly tenancies, which is about 83%. So tenants vacated just about 80,000 square meters, early terminations of leases just over 60,000, and then new lettings of about 123,000. So as we stand at the end of the 6 months, a vacancy level of 6.6%. Then the actual activity for the 6 months essentially shows the area renewed, the rentals at expiry, and the renewal rentals, and the 4% growth that we talked about earlier. I think it's important here to know that there were some big swings and roundabouts. For example, the Accenture lease in Woodmead and the Alexander Forbes lease in Rivonia were done at significantly lower rentals than at expiry. And then there were some big uplifts in terms of Emanzini and Parliament Towers, buildings occupied by government. These are currently the major leases under negotiation between now and the end of the financial year. As you can see, not a lot of large leases remaining. The majority have been achieved. There's approximately, well, there's 15 billion rands worth of monthly rental that's been renewed during this period, 230,000 square meters. I think what's important to note is that apart from the major swings, those that have a monthly alongside essentially are the government leases, the leases that have been renewed. Regrettably, in terms of the current government dispensation, all leases now get signed off at the DG's office. We think that could take a while. I'll give you an example. We negotiated a lease last year for 3 years. It took 18 months for the lease documentation to arrive. Again, the lease expiry profile. Last year, you may recall, we had approximately 900,000 square meters of space to renew. At the half year, that's down to 350, and 160,000 of that essentially contains the the monthly leases, and you'll see I've listed the 6 at the bottom, which in total is 104,000, which is the majority of the office monthly leases. For next year, there's 760,000 square meters to be renewed. I anticipate that by the end of this financial year, that will certainly be under 500,000, which will be within the 20% that generally one tries to set for oneself. Okay, acquisitions. Those are the 5 properties acquired during the period: the Discovery Building in Sandton, the General Motors Centre in Kucha, Tybalt Square in Cape Town, which has the head lease, 22 Fredman Drive, which is the Eversheds property in Sandton, and then UTI, a smaller property out of a portfolio. Acquisitions after Feb. The first 4 properties, industrial properties that we acquired from Improvon, they were transferred end of March. The remainder of the industrial properties are properties coming out of the Zemprop portfolios and Improvon, other than for Dawn, which we've acquired 50% from an individual. Chris Harney Crossing is the dominant shopping centre in Vosloorus. We managed to acquire 50% of that, and it's in line with the type of retail centre that we're looking to acquire. South Coast Mall, you've probably read about. We acquired the Hyprop stake of 50% at a particularly good yield, just over 11%. Bricker Road, and then the bottom properties are the Nickel Grove portfolio, which will come from Zemprop, hopefully by the end of the calendar year. And then disposals, 104 properties. As you can see, small properties, just under 500,000 square meters in total, quite a large vacancy proportion. And that's disposals post February. ShopRite Eloff Street, interesting story. Took 18 months for this property to be transferred, primarily because the 2 water meters that serve the building, council were unable to find one. They disallowed us from finding it for them. Took them 18 months to rectify the issue. Finally transferred. The following 3 retail properties are properties sold to Arrowhead. They're properties which have head leases, and we are in the process of trying to get consent to sell those properties. And then a number of smaller properties, and then the industrial properties are part of the Arrow Creek portfolio. Okay, then developments. These are the current developments underway at the moment. Pepkor, Mark alluded to, you're aware of that. Scania, 90 Grayston, Rotenbach Street in Roslyn is a new distribution warehouse. We're doing a 50-50 agreement, or we've come to a 50-50 agreement with the JD Group. Alberton Mall, a small reconfiguration of what has been very difficult retail space to let. And then the others I think have previously been discussed. Then future developments, there's 90 Rivonia, again discussed earlier. Sturdy Avenue in Rosebank. We hope to conclude an agreement with a large corporate to do a 50-50 development of approximately 40,000 square meters. Tabatsi Mall and Motlasana are 2 retail shopping centres we've acquired. They're both subject to 66% of the GLA being let to tenants acceptable to ourselves, plus SDPs in place by the end of June, and we'll decide at that point in time whether or not we take these forward. Standard Bank Centre in Cape Town, the intention is to build a deck of parking and to put on new facade to the building. Ottery Hypermarket, we're waiting the approval of application for 8,000 square meters of additional retail rights. And then One Tybalt will be probably an improvement to the parking ratios in time. And then completed developments, the Food Lovers Market in Park Meadows has been an absolutely outstanding opening. I think it was the highest turnover in the first week that they've done in any of their new stores. Mimites Road has now been complete. Kopanong development for ShopRite, again, very successful. We're now looking at whether or not we shouldn't do phase 2. ShopRite Paro, discussed by Mark, and then CTX Business Park, completed a few months ago. Thank you very much.
Okay, I'll just touch briefly on Redefine International. Their results have been out. came out on Monday. Mike Waters is in South Africa. Some of you may have seen him. He certainly will be in Cape Town tomorrow to talk to the Cape Town investors. Let me just say, I mean, there's a lot said about Redefine International's debt and the debt that has to be restructured. When we took the decision to go ahead with the Witchford transaction, we were fully aware that there was 300 million rands worth of non-recourse debt, and we had a plan to deal with it. The plan was simply to keep properties which we wanted and not take those that we didn't want at the current level of debt, and either buy them cheaper or let the service provider sell them. And that process is on track. It takes a long time. The wheels there move very, very slowly. But it's not something which is a surprise, and it shouldn't be a surprise to the market because it was alluded to at the time of the merger and hence the rights issue. We also got, remind people, 40 million in cash and 4 unbonded properties. So that on its own justified the transaction, and anything else is really optionality. So we're quite happy. The results are on track. You saw the distribution was on track. The NAV is down because of revaluations and various other things, but there's an explanation in the accounts, and we anticipate that that will come back. And you know, its investment in Cromwell has been fantastic, and I think from our point of view, it's really, we like the company, we like the management, we think management has got the capability to take it where it needs to go. The challenge for us locally is to find a way to get it, the structure reconfigured, so that we don't have to consolidate the companies, and an inward listing would really solve that. There are discussions in progress at the moment with the Reserve Bank and also various other alternatives. So hopefully by the year end we'll have more progress. We certainly will have resolution on the Redefine debt, and we will certainly hopefully have some kind of progress on the restructuring. Mike Waters is here this evening, and if anybody's got any specific questions, I'd ask you to have a chat to Mike. I don't want to step on his toes, and I've got to be very careful about what I say because the rules in South Africa are very different to those in the UK, and I don't want to get arrested next time I get there. The other important thing to note is when we talk about the disparity in debt between international and South Africa, if international, for example, buys a property in Germany at a 7.5 or 8% return, debt is available to them at 3.25%. So clearly, if they can get 60 or 70% debt against a particular property in Germany, for example, they're going to take it because it's enormously earnings enhancing. So very different to the situation here, where generally speaking, our debt is higher than the yield. They get a very substantial differential between the yield and the debt, and that's one of the reasons, but their debt is still too high. We see post the restructuring debt at around about between 55 and 60%, which we think would be reasonable for the kind of assets they have, particularly bearing in mind that against the 5 shopping centres, they have probably left now 23-year debt fixed at 6% against those shopping centres. So very safe and very cheap debt available to them. And so far as our prospects are concerned for the rest of this year, we're still going to focus on cost containment, sweating the assets. Our core property portfolio is anticipated to continue to achieve growth. Our full year distribution will be in line with prior guidance. Nothing makes us think that we should not achieve it. And we remain focused, looking for revenue enhancing opportunities that should translate into increasing distributions and long-term capital appreciation for our unit holders. I think if I look back 2 or 3 years, Redefine has transformed enormously from the company that it was, not just in terms of its property portfolio, in terms of the way we run the business. It's a team effort. I think that you can see that the quality of the information, the transparency that's coming through is very different to what it was. So I'd like to thank my team, my ExCo, our managers, and all the people that make up Redefine for what has really been a sterling effort to produce these results. We're not shooting the lights out yet, but give us a little bit more time, a little bit of improvement in the economy, and I hope that we'll be able to do it. Once again, thank you for your support. Hopefully we won't let you down. We appreciate your confidence, and I thank you.